Every single trader, when they open the chart, the first thing that they have to figure out is if the market is going higher or lower. In other words, the bias. But the bias alone is not enough, because two pairs can have the same exact bias, but one can result in a winning trade and the other one a losing trade. We're going to break this down fully. So the first thing that we're going to understand is how to successfully get a bias. Then the second thing we're going to go over is how we can understand which bias is better. First things first, bias. The bias, like we already mentioned, is a direction in price. So are we going higher or lower? Now, I used to always think that at every single moment in time, I needed to know what the bias was. And if I didn't know it, then it felt like I was failing. Now, I see this as well in a lot of other traders, but I need you to understand that this thinking is wrong. Bias is not a constant thing, as in it's not going to be clear at every single moment in time, 24/7, what the market is going to do and where it's going to head towards. But there will be brief moments in the market where, as I like to call it, the bias is going to be stupidly obvious. And what I mean by that is that the bias is going to be so extremely clear that even non-traders could say where the market is heading right now. And when that happens, that's exactly the moment in time when you want to act and when you want to capitalize from it. Now, what are these moments when the bias is stupidly obvious? That's a simple answer: when the market only has one-sided arguments. Now, let's break that sentence down. Because when we only have one-sided arguments, that means we only have bullish or bearish arguments. And the arguments, they tell us the probabilities in the market. So what I believe is one of the most important things to understand as a trader is probabilities, and that the market runs on probabilities, as in one thing is more likely to happen than the other thing. Nothing is a given, so nothing is 100% guaranteed. But when we can get, for example, 90% probabilities in our favor, then it's very likely that something is going to happen. So when there's only one-sided arguments in a market, that means it's very likely for one thing to happen. And that, like we mentioned, is based on probabilities. Now, probabilities are created through the concepts that we use. Meaning, if we look at the chart, then what is a bullish fair value gap like this? Well, a bullish fair value gap at its core is what? It tells us a potential direction in the market. So we understand when we create a bullish or bearish fair value gap, that creates a certain probability that if we create a bullish fair value gap, we might want to continue higher. It's an argument where, for example, if we have bearish fair value gaps, whilst at the same moment in time right here, also having bullish fair value gaps, that creates arguments on both sides of the market. And if you've been here for a while, you know I always like to use this analogy. Think of it like a courtroom. So when you walk into a courtroom, you usually have two parties. And in our case, that's going to be on the left side might be the bullish party. On the right side, we're going to have the bearish party. Imagine yourself to be the judge in the middle of that courtroom. And what you're going to do is you're going to observe the arguments that the bearish side and the bullish side are giving you objectively through the concepts that we use. So in this example, the bullish side might say, well, we have a bullish fair value gap right there. We also have a bullish fair value gap right here. And we also create more bullish fair value gaps afterwards as well. And the bearish side only has one argument, and that is this old bearish fair value gap that already has arguably been disrespected. So then what happens is that the bullish side is simply winning because the bullish side has a lot more arguments than the bearish side. And then when one side is winning, that gives us an idea of what the probabilities are. Again, probabilities are the following. If there are multiple options of what can potentially happen, meaning there are arguments for both sides of the market, a lot of people think that they are doing something wrong. They can't get to a bias. No, that's not true. If there are arguments on both sides of the market, then there is no clear bias. That's not your fault. Actually, on the contrary, you did very well, as in you identified that both sides of the market have equal amounts of arguments, meaning that it's not clear what the bias is at that moment in time, but don't dwell on it. And what I mean by that is don't get lost in the thought that you are doing something wrong if that is the case, because you're not doing something wrong. And the more options of what the market can potentially do, the lower probability it is in general. Whereas if the market can only really do one specific thing, then it's very high probability. Now we talk about these arguments and how these concepts create these arguments. Let's understand that a little bit more clear. In my opinion, what you really need to understand is fair value gaps and then also in turn candle signs, which are essentially the same thing. So fair value gaps, I think, are very clear. Again, it's a 3 candle pattern. This, for example, is that bearish fair value gap right there. That tells us what the potential direction is in the market, because historic evidence shows us that when we are going higher, we are creating bullish fair value gaps. When we are going lower, we are creating bearish fair value gaps. So fair value gaps give us an indication of what the market is potentially doing. This is also true for fair value gaps located within singular candles. So what do I mean by that? This candle that you're seeing right here with the long wick at the bottom that has a sting into this bullish fair value gap, it's not just a candle. And what I mean by that is every single candle is made up of lower time frame fair value gaps. So we're currently on the 4-hour time frame. If we now go down into the 15-minute time frame, then we see that long wick turns into also fair value gaps, where we first have fair value gaps going lower right here to then fair value gaps going higher. So in other words, if we go back to the 4-hour time frame, this long wick tells us that we are reversing from this fair value gap to potentially continue higher again. And then in other words, we are simply respecting this bullish fair value gap right there. So the bullish fair value gap that we have, that in itself is already an argument. But then respecting the bullish fair value gap is also an argument. Then once we create a new bullish fair value gap from the previous bullish fair value gap that we had, that in itself is also again an argument. So just by looking at bullish and bearish fair value gaps and seeing if we are respecting bullish or bearish fair value gaps, that creates the arguments that we need to get to a clear bias. So if we break this price action down a little bit right here, then we see we first had a sting into this bearish fair value gap and also this bearish fair value gap right there, whilst also creating a bullish fair value gap right here. So at this moment in time, what could the arguments be? Well, we have 2 bearish fair value gaps, where one of them we are respecting the bearish fair value gap right there. And we also have a bullish fair value gap right here that we're also arguably in the beginning also respecting right there. So that overall creates, again, that courtroom where the bearish arguments, I would say, are winning at that moment in time because there are more bearish arguments. But it does not create one-sided arguments because we also have bullish arguments to be made right there. So then if we look a little bit further afterwards, we see that we now create this bullish fair value gap right here. And that we are also respecting this bullish fair value gap. Now we also have this bearish fair value gap right here, but it does not seem like we are respecting that in any shape or form. So what have we done in this little sequence? We went from a little bit more 50-50 price action where we had bearish and bullish arguments to when these bearish arguments are now taken away and we only have these bullish arguments right there, that tells us that price action for a brief moment right here is quite obvious because we only have one-sided arguments, which means right here that once we do create this fair value gap right there, we can potentially continue higher from it towards these highs right there. This is what we call in the MMT a no resistance run. Why? Because we only have swing highs left right here that are holding price back potentially to reaching these highs, where every bearish fair value gap that we previously had has already been disrespected. We're not respecting it like we see with this bullish fair value gap right here. So this is how we can successfully get to a bias when there's one-sided arguments. But now part 2 comes into play because what we're looking at right here is Euro US dollar. Euro US dollar we have just determined to be bullish at least until we reach these highs right there. Now the way correlation works is that if Euro US dollar is bullish, that means the US dollar, so the last part of the ticker name, is bearish. So what that means is that if Euro US dollar is bullish, that also in theory should mean, according to correlation, that Australian dollar US dollar is also bullish. But this is where it becomes very important to understand that you should always pick the right pair to trade. the one with more arguments supporting the idea of, in this case, being bullish. So what we see right here is Australian dollar, US dollar. And this, what you're seeing, this fair value gap is the same fair value gap that we had on Euro US dollar. So this fair value gap sitting right here. Now, since they both have that same fair value gap, you could argue, well, you can also trade Australian dollar, US dollar right here, right? No, why not? Well, let's compare Australian dollar, US dollar and the arguments that we have compared to Euro US dollar. If we go up a time frame right here into the daily time frame, then what we see on something like Australian dollar, US dollar is first of all that we have this large gray box on the top left, which is what? The monthly bearish fair value gap sitting right there. Again, that bearish fair value gap is in itself already a bearish argument. We're also arguably respecting it right there. It's another bearish argument. So if we then go back into the daily time frame right here, what do we see on the daily time frame? That we have this bearish fair value gap. We also have this bearish fair value gap right there. And we are again also arguably respecting those bearish fair value gaps. Now, if we then go into the 4-hour time frame, then what do we see again? Well, we do have this 4-hour fair value gap right there that tried to push lower, failed to do so. So in other words, this bearish fair value gap was a bearish argument, but is taken away. It's not a bearish argument anymore. So we now have a bullish argument instead, this bullish fair value gap. So is that now a bullish fair value gap that we can potentially trade back into to simply continue higher from? Well, on the monthly, we saw bearish arguments for Australian dollar, US dollar. On the daily, we also saw bearish arguments right there for Australian dollar, US dollar. The only bullish thing that it has going for it right now is this bullish fair value gap right here on the 4-hour time frame. So that means, first of all, the arguments are telling us that we might be more bearish than bullish. Next to that, it's also not one-sided arguments. So right here, when something is not one-sided, what does that lead to? That leads to a potential consolidation. So what you'll notice if you compare Australian dollar, US dollar to Euro US dollar, which we have just seen before, then Australian dollar, US dollar will struggle a lot more to push higher right here in comparison to Euro US dollar from the same exact fair value gap right there, because Euro US dollar has less bearish arguments right there, which then in turns mean that Euro is simply said stronger at this moment in time than Australian dollar. And this simply means that even though Euro US dollar and Australian dollar US dollar have the same bullish bias, Euro has less bearish arguments in comparison to Australian dollar. So Euro is stronger than Australian dollar. And when we are looking to buy, you want to trade the stronger pair, in this case, Euro US dollar. Now, if, let's say, the US dollar were to turn bullish all of a sudden, and we understand Euro US dollar and Australian dollar were to turn bearish, then Australian dollar, US dollar would actually be more interesting. Why? Because it has more bearish arguments. This is how we can objectively understand what the probabilities are of certain pairs and which pair we actually want to trade. We go very in depth in this in the MMT, because this is also what is known, and MMT members will know it, as a filtering process. Now, to become a professional trader, implementation is key. And that's exactly the difference between YouTube and MMT. Because with that implementation, you can now arguably make it very objective what we are looking at as well. Now, if you want to learn more about that, I would highly advise head on over to tradingmmt.com, first link in description. And for any questions that you might have, of course, also send them to info@tradingmmt.com. All right, perfect. Thank you.